Good morning. The purpose of this video is to go through the basic accounting principles in order for students to catch up or to revisit some of the basic accounting concepts. Accounting is, we can call it a language used in business in order to record and keep track of everything that happens in the business. And in order to do that, we don't use normal English language or words and sentences. We use accounting language. And the purpose of this video is to quickly go through the basic methods of writing things down and recording things in the accounting books or the accounting records. But before we can get there, everything in accounting is based upon the accounting equation. Now, the equation is a mathematical equation, which you can see on the picture of assets is equal to liabilities plus equity. However, even though it's a mathematical equation, it's actually a logical equation as well. Let me explain. If you want a vehicle, there's either one of two ways that you can fund the purchase of a vehicle or any other type of an asset. So we take this picture of the vehicle. There's only one of two ways that you can fund the vehicle. You can either go to the bank and get a loan, which is a liability, or you already have the money in your own bank account, or you get somebody else, like in this case the owner, in a business case the owner, to pay for it. So in a business context, assets are always either funded through liabilities or through equity. Equity represents the owner of the business, and liabilities are things like loans or trade payables. It's usually represented by people that or the business owes money to, and assets are, I guess, the easiest to understand. It's things that we can actually use, we say it's an economic resource that we use in the business to actually make money. For example, vehicle or even cash is seen as an asset. Okay, that's the basic basis of everything. And because accounting process is based upon an equation, if you remember from your knowledge of equations, if I have an equation like this and I say 10 is equal to 5 plus 5, if I decide to add 2 on the one side, on the left hand side of the equation, let's say I say plus 2 plus 10, that gives me then 12. Now for this equation to still be true, I need to add the same amount on the right hand side of the equation. So I have 5 plus 5, but since I've added plus 2 on the left hand side, I need another plus 2 on the right hand side. Otherwise, the equation will not hold true. So this principle of if something changes on the left hand side of the equation, it needs to change on the right hand side as well in order for the equation to remain true, is called the double entry rule in accounting. And we say if anything changes in assets, there needs to be a change in liabilities or in equity as well. Because anything that you write out in accounting, this equation must still be equal. So assets must always be equal to liabilities, and this is usually represented in values for us to keep track of and make sure that all entries were made. Now the next thing, it's the first, or some of the we call it books that we use in accounting, and the first one that I want to look at is the general ledger. Now the general ledger is literally a book, and it consists out of, this book consists out of what we call T accounts. Can you see that looks like a T? But it's an account. Now sometimes when you record information, you can record something in a table. So you'll have a heading and you'll say this is bank and that's assets and that's a liability, and then you record things in a column and say, oh, plus If the column increases, you add it. If the column decreases, you subtract, and then in the end you can get a total. Okay, that's the normal column that one can use to record information. But in accounting, they said, since we want to show the equation that needs to hold true, we don't make use of columns. And it's because of the amount of information that an accountant has to record, a column is it's unpractical. So a better way that somebody came up with is the T account. Now the T account, for literally every asset, for every liability, for every income, every expense, every equity item, would have a separate T account in the general ledger. So for example, your bank, which represents your cash, will have its own T account. If you have a loan, it has its own T account. If you have a vehicle, you will have a separate T account for that, etc. Now how this T account works is the left-hand side of the T account is called the debit side. Now that's just an accounting word. Left hand in accounting means debit. Right hand in accounting means credit. And if we talk about the credit and the debit side, we refer to the left-hand side of the ledger account, which is the T account, or the right-hand side of the ledger account, the general ledger account. Okay, that's something to understand. And then we'll look at it a bit, but different type of elements. Now the elements are the assets, liability, income, expense, and equity, increases or decreases on the debit or the credit side. So for example, assets increase on the debit side, so that means if you have amounts that increases the asset, you need to write it on the debit side. If you have amounts that decrease the asset, you need to write it on the credit side. So for that will cause you to be able to say, when I find out how many vehicles do I have, I add up everything on the debit side because that increases the asset, and I deduct everything on the credit side because that decreases the asset to get to a final amount. The next book in accounting, it's actually the first book in accounting, we call it the General Journal. Now, it's called the first book of entry because in the General Journal we plan as to what we will be doing in the general ledger. And on the screen I've got a basic example. The General Journal, you would go and think about what account, so what element, what item needs to be increased, which item needs to be decreased, or perhaps both items need to be increased, but you need to think about what happens. Now, in this example, the entity purchased a vehicle for 100,000 Rand and they paid cash. Now, since vehicle is an asset and assets increases on the debit side, I'm saying in the journal that once I go to the ledger, I need to debit the vehicle with 100,000 since my vehicle increases with 100,000. But because of this equation and the fact that the equation, and if I do something on the debit side, which is the left-hand side, I need to change something on the right-hand side as well. There will always be an equal amount of debits and an equal amount of credits. So because I've debited, showing an increase in vehicle, there's something else that happened. In order to get the vehicle, I had to pay for it, and I paid in cash. So therefore, if I look at my cash, it actually decreases with 100,000. Now, bank is also an asset, and assets increase on the debit side, and therefore it will decrease on the credit side. So I'm going to credit bank with 100,000. Okay, now I want to show you and look at it. Follow the blue transaction for the debit side, follow the red transaction for the credit side. Look at how it's recorded in the ledger. Now, the journal is literally just an instruction that tells me what I'm going to do in the ledger. So when I say in the journal, debit vehicle, I'm actually saying go to the vehicle ledger account. So as mentioned previously, each item that you have in the business will have its own ledger account. So there would be an account, a ledger account for vehicle. And my journal tells me go to vehicle account, which is there. And once you are there, you go and write on the debit side. So debit side means on the left-hand side, you need to write down 100,000 rand. And then there's a column in the ledger for the description. That it's not a description. People tend to think it's a description, but it's actually a cross-reference to the other side of the transaction. So I'm asking myself, if I debit vehicle like I'm doing here with 100,000, what is the other account involved? So which account will I be crediting with this exact same amount? And that account is called the contra account. Now in this case, I debited vehicle and I credited bank. So my cross-reference would be bank. And then in the bank account, it said in the journal, go to the bank ledger account, which I've done, and write on the credit side, so that's on the right-hand side, write down 100,000. And it's there. What do you write in this, where you have to write in a word? You write down the contra account. The contra account is the other side of the entry. I've credited bank. Where will I find the other 100,000? I'll find it in the vehicle ledger account. So in that way, you cross-reference so that if somebody just reads the ledger and they read this transaction in the vehicle account, they'll be able to say, oh, vehicles were debited since the entry was made on the left-hand side. So vehicles increased with 100,000. And at the same time, bank decreased, was credited with 100,000. So you can literally look at the vehicle entry on its own and be able to see both the debit side and the credit side of the entry. And the same goes for bank. And then the fourth very important principle that everybody that does accounting needs to memorize and know by heart is this screen that you've got here. And this, you need to know this. Assets increase on the left-hand side, so on the debit side. Liabilities increase on the credit side in the ledger. Equity increases on the credit side, income on the credit side, and expenses on the debit side. Now you'll be able to see if you just look at the asset, liability, and equity, if you remember the equation of A is equal to L plus E, you'll see asset stands on its own on the left-hand side. So if you write the equation like this, then you could just remember, since asset in the equation format stands on the left-hand side, it always increases on the left-hand side. Liability and equity stands on the right-hand side, on the credit side of the equation, and therefore liability and equity will increase on the credit side. Income increases equity, because income is the amount of it's the money that we receive for producing or doing the purpose or rendering a service or selling the goods. So it's the purpose of the entity. And that income belongs to the owner. So because the owner, which is the equity, owner's portion, which is equity, increases on the credit side, income also increases on the credit side. And expenses are those things that you need to pay on a regular basis in order for the business to operate. And an expense is the opposite of an income, and therefore it will increase on the debit side and not on the credit side, such as income. Thank you. This is a short video, and let's stop here and we can continue with the next one.